Bloomberg Audio Studios. Podcasts, radio, news.
So here's the latest this morning. The New York Fed President John Williams pushing back against hawkish commentary from the FOMC and Wall Street, now pricing in better than 50% odds the Fed will cut rates in December. Fed Governor Stephen Miran was the lone dissent for a 50 basis point rate cut at last month's FOMC meeting, and Governor Miran joins us now for more. Governor Miran, good morning. Good to see you once again. Thanks for being here.
Thanks for having me back.
We've got to start with the labour market. Your reflections on what we saw yesterday, does it lean one way or the other?
Yeah, I think the implications of yesterday were obviously dovish, and if anyone was on the fence, I would hope that this would move them in the direction of cutting. You saw the unemployment rate edged up a bit. You saw some other indicators like an increase in permanent layoffs. Those are indications that the labor market has been affected by restrictive Fed policy. And given the outlook for inflation, there's not really much of a need to be as restrictive as we are.
And yet on the committee, we have pushback. Almost immediately after that, Fed Governor Michael Barr had this to say: I'm concerned that we're seeing inflation still around 3%. Inflation's closer to 3 than it is to 2. What do you make of that argument? How persuasive is it?
It's not persuasive to me, and I'll tell you why. Almost all of the inflation excess is a mirage. It's not indicative of supply-demand imbalances. And so, for example, if you look at the housing market, right, market rents have been running at about 1% for a couple of years. Measured inflation in the index is actually much higher than that because it takes a really long time for the index to converge down to where market rents are. That's a statistical artifact, right? That's an artifact of the statistical measurement process. It's indicative of a supply-demand imbalance that was there in 2022, 2023. Monetary policy works with lags. It has to be set now for 2027. So when you look at the housing data, right, you see market rents running about 1% for a couple of years. There's no supply-demand imbalance there. We should not be setting policy for 2027 based on a supply-demand imbalance that existed in 2022 or 2023. That doesn't make any sense. There's other things, too, like portfolio management services, which confuse quantities for prices. This stuff is all well known. If you look at market-based measures of inflation, they're much closer to 2 than they are to 3. So I think that the excess, the overage, is a mirage, and it's a mistake to ask people to lose their jobs because of quirks of the statistical measurement process.
And you've got to put out new forecasts on December 10th as well, which is going to be complicated by the fact we've had limited data more recently. How relevant do you think the calendar actually is? Because I'll offer you the perspective on Wall Street at the moment. It goes something like this. The meeting's on the 10th. You don't get the data until the 16th. The Fed's kind of constrained by that. They can't do anything. What's your perspective on that?
Yeah, so as I said a moment ago, monetary policy works with lags. It would be much easier if it hit the economy immediately, but it doesn't. It works with lags. So you have to set policy based on the forecast. So the data matter insofar as they affect your forecast. It doesn't make sense to be setting policy for where the economy was 3 or 6 months ago. We should be setting policy based for where the economy is going to be 12 to 18 months from now. And so if we have data, it gives us the ability to update our forecast. But the lack of data doesn't mean that we don't have a forecast. We did have a forecast. And all it gives us is opportunities to falsify our forecast. And there hasn't been anything in the data, in the news, in media stories, in private sector data, alternative data that's available to us, that would make us think that the forecast is somehow nullified and there's been a big shock to it. So if anything, all the information that we've got in the interim since September FOMC has inclined to the dovish side. We got weaker inflation than people expected, and we got a higher unemployment rate than folks were expecting. So all of that information should push one in the dovish direction.
But there are still Fed officials that are looking for more data. And they have said they're data dependent. They want that insurance that they're cutting right now, and it's the right time. Potentially the unemployment rate might be moving up to 4.5% on December 16th. Would you be in favor of just moving the meeting if it meant others felt more reassured to cut interest rates in December?
So, I haven't really thought about that, and it's not a conversation that I've been part of. I agree the meeting dates seem kind of arbitrary, but at the same time, there's a lot of stuff that gets done as a result of those meeting dates, and people have investments and contracts and other decisions that are tied to the timing of the meeting date, and I don't know to what extent moving those dates would be disruptive for all that. So it's something that I'm not sure about. But this ultimately comes down to the question of data dependence is what you do when you don't have a forecast or when you don't have any confidence in your forecast, right? We should be forecast dependent, not data dependent. Being excessively data dependent is to be too backward looking. And if you're too backward looking, you necessarily are going to have the wrong policies.
Neil Dutter writes in, he says, the only question that matters for you is, will you dissent for 50 if you believe it means not being able to push through a 25 basis point cut?
Yeah, so absolutely not. I would absolutely vote for a 25 basis point cut if my vote were the marginal vote. There's no question about that. To do otherwise would be to cause real harm to the economy for purposes of vanity, and that's not who I am.
Going into next year, talking about the forecast of what's going to happen, a lot of economists who come on the show expect a reacceleration on the backs of the tax refunds and some of the other stimulative measures that could come early next year. How do you factor that into your forecast for ongoing weakness in the labor market and the consumer?
Yeah, so I think that, I have not been what I would think of as excessively pessimistic on the economy. I do think policy is restrictive, and I do think that it's too restrictive, and we don't need to be. And the longer we remain restrictive, the greater the chances that we are the source of an economic downturn, which we should not seek to be. I think that many of the factors that will be kicking in over the next 12 months that might be supportive of GDP growth are things that necessarily don't have hawkish implications for monetary policy because they affect the supply side. And when you think about things like relaxing regulations, and I think that has been going on at actually an impressive pace, these are things that push out the supply side of the economy and therefore don't necessarily create a demand excess of supply. Right? Monetary policy should be tight if demand is too much in excess of supply. And if you push out the supply side of the economy, then that's not something you worry about.
There's a duration mismatch here, though. The idea that if you reduce regulations and you allow people to build supply, that it takes a longer time than, say, if you give people $2,000 checks right up front that they can spend immediately, or if they get a rebate that's a lot bigger from their tax filings. How do you factor in that timing mismatch? Would you look through any bump up in inflation next year from both stimulative measures as well as the price increases that we're hearing from a lot of retailers that they're going to pass along?
So, I wouldn't look through bumps from checks like that, right? I don't think that you'd be able to. However, a policy like that hasn't been formalized. It hasn't been introduced. We don't know the parameters of it. It's too early to sort of think about basing a forecast on something like that. What we do know is that the labor market data have been coming in not as strong as we'd like them to be, and that policy is too restrictive.
Governor, if we can stay on inflation, do you know when we're going to get some inflation data? When are we going to get that? Because we've heard about the payroll schedule. I haven't really heard anything about the CPI schedule. You got any indication whatsoever of when it's coming? Yeah,
the BLS put it out on its website this week. I think that we're not going to get the November CPI data until after the next FOMC meeting.
So we've got to wait for that too?
We've got to wait for that.
Did you see that, Lisa?
Yes, I did. I saw that we have to wait, and it's not clear exactly when we're going to get it, but there's a real question going forward about when we might get it.
But we don't have the dates yet.
But we don't have the dates.
No, the dates are on the website. Yeah. The BLS has a list of the release dates on their website.
I saw the payrolls one, but I've missed the CPI one.
Yeah.
Which doesn't that just make it an even stronger case just to wait and have this meeting when we've got all this data? Why is it that we have to wait so much longer for it, Governor?
Wait for the data?
Yes.
Well, because the government shutdown introduced a whole number of snags into the data collection process. And so those snags mean extra time to collect the data, extra time to process the data. People have a logjam of work to get back to. I mean, we just, sort of spent several years talking about bullwhips from supply chains, right? And, the demand gets pulled in at once. And when you have a government shutdown, all the government employees aren't working, and they come back to work, and they've got a ton of work to do all at once. And so, we have those bullwhips in government data right now. And, if that were a market, you'd see some inflation in the price of data. But it's not a market. So.
Forgive me for coming out with the hawkish hits, but we got another one in the last 24 hours too, and it came from Beth Hammock. Lowering interest rates to support the labour market risks prolonging this period of elevated inflation, and it could also encourage risk-taking in financial markets. Can we finish on that last point? Risk-taking in financial markets. How excessive is it, and should it be on the radar of the FOMC?
Sure. So first of all, as I said before, the excess of inflation is a quirk of the statistical process, and it is a mistake to ask people to lose their jobs as a result of a quirk of the statistical process. On financial markets, look, I think that lots of things affect financial markets. Tax policy does, regulation does, technology like artificial intelligence does. It's a mistake to conflate the status of financial markets with the status of monetary policy, right? Even when you look at something as a financial market as deeply connected to monetary policy like interest rates, we've lived through periods of conundrums, right, where passing through of the Fed funds rate into longer term interest rates was confusing to people. So it's just a mistake to do a one-for-one mapping of these things. And I think that when you look at financial conditions, the financial condition that matters most for the real economy has been and remains housing, right? And this is an area where financial conditions are not loose. This is an area where financial conditions are still quite tight. Going out, getting a mortgage, this is not something that's not a financial condition that I would consider to be excessively easy. And so I think it's a mistake. And I think it's also a mistake, as I said before, to ask people to experience job losses because you think the stock market is too high. I don't know what the right level for the stock market is. And I think that it's a very challenging question to be able to answer credibly, and to say that we need to create job losses in order to sort of restore the stock market to some level that we think is more reflective of fair value is just not a policy view that I hold.
A lot of people have come on this show and said that right now the Fed is stuck between a conundrum of the K-shaped economy, where you have people at the upper end who are doing just fine and are supporting consumption, and people on the lower end who are experiencing a lack of wage gains, and they're experiencing those job losses more significantly. How concerned are you about sort of your dual roles of trying to help prop up and prevent some of those job losses from really escalating, while at the same time potentially cutting rates would exacerbate that K-shaped and only exacerbate what you're seeing with respect to the wealth divide? So Congress didn't task us with addressing all social problems in the world, inequality one of them. They tasked us with tackling aggregate maximum employment and stable prices. And so therefore the right policy to take is to stabilize employment and prices. And that's the policy that I support. I do think, though, while discussing the subject of inequality, it would be much worse for the people at the lower end of the income distribution if the unemployment rate continued to go up as a result of our policies. That's not something that they would welcome, and it's not something that I would welcome either.
Governor, I was with the president this week in the Oval Office, and I asked him about the Fed interviews. He says lots of names. We may go the standard way. Quote, it's nice every once in a while to go politically correct. Out of the names that we know that are being interviewed, who is politically correct?
I don't really know the answer to that question.
You worked for the president, so you understand how his mind works. Do you think it means someone that is currently on the board, like a Governor Waller, or someone that's very close to him and your former colleague, Kevin Hassett?
Yeah, so, it should be pretty clear that I just always say what's on my mind, and therefore I don't even know what politically correct is. So I don't even know how to begin addressing that. But look, I don't make personal decisions.
You're being too politically correct right now, actually.
Am I? I've never been accused of that before. So, hey, I'm happy to have it first.
Governor, very diplomatic. It's good to see you. Thanks for dropping by.
Thanks for having me.
Thank you, sir. Thank you very much. The Fed Governor Stephen Miran.